So good evening everyone. My name is Maurya Hanspal, and in this session we're gonna continue our session on some of the tools to analyze the stock market. So this is the session number 4. Like when we are talking about some of the tools to analyze the stock market. And in the previous session, to recall, we have already talked about to calculate the holding period return from the stock prices. We had a certain data for like 7 days, and all the formulas which we talked about, all the practical theories and concepts that we talked about are applicable to the data, be it 5 years, 10 years, or 12 years. So that is one thing which need to be understood. We learned how to calculate the holding period return, both from the capital appreciation as well as the dividend. We learned how to calculate the mean returns of the stock, the riskiness of the stock, which is measured by standard deviation or variance. The both are one and the same thing. Variance is just the square of standard deviation, and standard deviation is the root of variance. So that we try to understand. Also, we talked about that higher the standard deviation or higher the variance, the stock is more risky or the company is more risky. Then we also talked about the systematic risk and non-systematic risk, standard deviations, how to calculate beta, your measures of central tendency or mean, your measures of dispersion we talked about, the standard deviation we talked about, variance we talked about, coefficient of variance. Then we also talked about the measures of association, that was covariance and correlation. So that was something we talked about in the previous sessions. And also we talked about how to calculate beta or the systematic risk or the non-diversifiable risk. So all these things we have already talked about in detail in the previous sessions. So any of you who want to learn and miss those 3 sessions, just type it on the YouTube channel of College Dekho, Tools to Analyze Market by Maurya Hanspal sir. And you'll get all the recordings. And apart from that, a complete lecture series on stock markets, on fundamental analysis, the technical analysis series is on the way. And a part of valuation series also, like you'll get there, and a large range of other topics which you should know to start your career towards financial literacy and as well as financial independence, which you believe and you are capable of. Thanks to College Dekho for giving me such an opportunity to be here. Okay. So talking about some more tools. So as my promise continues for you, in this section we'll be talking about like one of the most important ratios, okay, like which are used to analyze the stock markets or the returns from stock markets. The one of the ratio that comes into place is the Sharpe's ratio. And this Sharpe's ratio is very popular in the mutual funds industry. In the mutual funds industry, this ratio is used very popularly to gauge the performance of the mutual funds and to test the riskiness that the portfolio, like which is consisted of a various number of stocks in a mutual fund, people or the mutual fund analyst or the portfolio managers, they try to analyze the riskiness of the fund. So it is also used in case of mutual funds as well, but particularly talking about the stock market. So basically you have a formula, and the formula for this is RM minus RF divided by standard deviation. For all of those who have seen my classes on capital structure and have knowledge about financial management, they clearly know that what do we mean by RM, RF, and standard deviation. Also, people who are doing the course of financial management in BB or BCom or even MBA, they also have an idea like about these terms. So I'll just like brief these terms for you. This RF is the risk-free rate of return. That is basically when you are investing in government securities. So government securities can be government bonds, it can be government notes or government bills. So these securities are the safest securities because government won't default on their obligations. So if you are investing in these debt instruments, you will like surely get a return. But the amount of return or the quantum of return that you would get from these securities would be very less because you have taken no risk or a negligible amount of risk. And the basic finance theory, higher the risk, higher the expected return, and lower the risk, the lower would be the return. So in this case, you won't be getting a very high return because your investments are secure. But what happens in case of RM? RM is the return on market. That is, you have taken some risk and invested in direct stock market, that is equities. And equity market again is very risky. It can go up and it can go down. So when you are investing in equity markets, you are taking a higher risk. And higher risk ideally means a higher expected return. So in most of the cases or all of the cases, the value of RM would be greater than RF. And when the value of RM is less than RF, do not invest in stock market. It is better to invest in RF only. So that is the government securities and bills. But like basically, so that won't happen. RM would RM would give you like more return. And what is this? This is a standard deviation. Standard deviation is a measure of riskiness of the security. That how risky is your security. Okay, higher the standard deviation, the more risky the security, and lower the standard deviation, the less risky your security. So that thing you need to know. So like what would be mentioned in the question, your RM would be mentioned to you. In the question, they would say you that return on market is like 10%. The return on like government securities is 4%, and your standard deviation is 5. So calculate the Sharpe ratio. So that will come out to be like 6 by 5. So when you divide 6 by 5, you get 1.2. So 1.2 is a Sharpe ratio. Sometimes they can also say you the exit return on the market is 6. So instead of giving you RM and RF, so they would just say you the exit return on market is 6. So that just means that your market risk premium, the value of all this bracket or all this formula is 6. Okay. Now, in case of Sharpe ratio, obviously like you will want a higher Sharpe ratio. And why you would want a higher Sharpe ratio? Because you want the least amount of risk to be taken and the maximum amount of return. Because when we look at this ratio mathematically, okay, so like when this ratio would be higher, this ratio would only be higher when your standard deviation is less. Your denominator is less and your numerator is more. And when your numerator is more, this ratio would be higher, right? So that we need to understand. So higher this ratio, it is good for a company because that shows that you are taking less risk in order to get like more return. So that was what Sharpe's ratio all about. And all of those who have watched my lecture series on capital structure, they know that Sharpe ratio is also the slope of the CML line or the capital market line. Okay. So talking about the next ratio. So when we talk about the next ratio is the trainer's ratio. The next ratio is the trainer's ratio. Again, the formula also remains the same. So what you do in trainer's ratio, RM minus RF remains the same. But in the denominator, instead of taking the total risk or the non-systematic risk, which is represented by standard deviation, so what do you take? Like you take beta. So it is the exit return over the risk-free rate over beta. So in this case, we're just taking into consideration the systematic risk of the market or the non-diversifiable risk or the market risk. But in case of what? But in case of the Sharpe's ratio, you took into consideration only your standard deviation, that is your whole risk. And your whole risk or standard deviation, it includes both the systematic risk and the non-systematic risk. But in case of Trenner's ratio, we're just taking into consideration the that is basically the systematic risk only. And beta is a proxy of systematic risk, which we have already talked in the previous session. Again, in the question, it would be mentioned to you that the return on market is 15%, your risk-free rate is 4%, and market beta is 2. Okay, so calculate the Trenner's ratio. So that would basically be 11 by 2. So 5.5 would be the Trenner's ratio. Okay. And again, we want the higher this ratio, it is better for the company, same as the Sharpe's ratio. Because what would the highest tenor ratio indicate? The highest tenor ratio would indicate that your denominator is less. That is, your market risk is less and you are getting more return. Okay. So these kinds of ratios that, for example, your Sharpe's ratio, your Trenner's ratio, these kinds of ratios are used to evaluate the stock performance and are used in the mutual funds industry as well. Okay. So that you need to understand. One more concept I will talk about. So before talking about this one more concept, I'll just present my screen to you. Yeah, I'll just present it to you. A specific document which I had prepared. Okay. There is one ratio in the market. There is one ratio in the market which is like popularly called as your Sortino ratio. Sortino ratio. So what is Sortino ratio? The formula remains the same. Rm minus Rf divided by the standard deviation. Now you will say Sharpe's ratio's formula was the same and Sortino's ratio's formula is also same. Then what is the exact difference between Sharpe's ratio and Sortino's ratio? In Sharpe's ratio, you are taking the whole unsystematic risk or the risk which can be diversified away in the form of the standard deviation. That is whole standard deviation you are taking into consideration. But what you are doing in case of Sortino ratio, again you are taking the whole standard deviation into consideration. But what are you doing? You are taking into consideration all the negative standard deviation, all the downside standard deviation. All those who are like familiar with the measures of central tendency and measures of dispersion and know about statistics. So what does the standard deviation mean? It means if your mean is in the middle, how much points away is your value? So that is the standard deviation or the variance कि ये वाला point mean से कितना दूर है, right? Again this point can be away from the mean both in the positive direction as well as in the negative direction, right? Because it takes into consideration both the directions. But what happened in case of Sharpe's ratio? Sharpe's ratio was taking into consideration both the positive direction and the negative direction. But what this Sortino ratio takes into consideration, it takes into consideration only the negative side. मतलब इस साइड को बस देखता है, इस साइड को नहीं देखता. So that is the Sortino ratio. For that, I have like specifically created a kind of numerical for you on the Word document. So it basically says the yearly returns of the stock are given. Assume the risk-free rate is 5% and calculate the Sortino ratio. Now these yearly returns have been given to you. These yearly returns are nothing but the holding period returns, and that we know how to calculate like these returns from the stock prices. So these are like some of the returns given to you, and both the positive as well as the negative returns are given to you. Okay. Now from this data, you have to calculate the Sortino ratio, and the data has been taken from the year 2013 to 2020. And you have to calculate the Sortino ratio. And both the kinds of returns are given to you. That is the positive return and negative return. Now, ultimately, you cannot work directly on these returns because what does standard deviation means? It means first you have to find out a mean and then check the standard deviation kitna dur hai. And you will be taking into consideration only the negative standard deviations and not the positive standard deviations in the case of Sortino ratio. But in case of Sharpe ratio, you will take into consideration both, that is the positive and negative. So starting from 2013 to 2020, you have the positive and negative returns. So what have we done in the further calculations? I have taken out the mean of these returns. From 14.50 we have added 18, then minus 4, minus 6 plus 12.5. So जहाँ पे add है वहाँ पे we have added, जहाँ पे subtract है वहाँ पे we have like subtracted. And the number of observation we have 1, 2, 3, 4, 5, 6, 7, 8. So we'll just verify it once again. 1, 2, 3, 4, 5, 6, 7, 8. So the observations 8 we have. So firstly, we found the mean return and we know how to find the mean return. The total number of the sum of the observations divided by the total number of observations. And then we took out the standard deviation. That was basically R minus R bar. That is, ये हमारा जो mean आया है 6.25. So we have done like 14.50 minus 6.25, 18 minus 6.25, minus 4 minus 6.25. So all these things we have done in the previous session. And now we have taken the square of the negative deviations only. जहाँ पे आंसर negative आ रहा है तो उसी का square we have taken. We have not taken the square of the positive deviations. So we took the square of the negative deviation. So we have 3 cases for that for 2015, 2016 and 2020. And we summed them up. We got a total of 542.798. Okay. Now how you calculate the variance? Your formula comes out to be your total and it's like divided by n minus 1. Okay, so what's your n? N is 8. So 8 minus 1 would be 7. So 77.54 is your variance. because you have taken the square of it. अगर तुम सिर्फ इसको ऐड करते हैं, the answer would come out to be 0. So to find standard deviation, first you have to like find out variance. Okay, and these things we have done in detail manually, hands-on experience के साथ we have done in the previous session. Okay, so here is your standard deviation, and that includes only your downside standard deviation. Okay, you got is 8.808. So जो भी आंसर आएगा, like for example 8.808 would be in your denominator, right? Just imagine the RM is 15, RM is 4. Okay, so that would be nothing but 11 divided by 8.8. 11 divided by 8.8. So like you will get the answer as 1.25. Again, this ratio should be as high as possible because negative standard deviation हो रहा है तो मतलब कि नहीं होना चाहिए. Standard deviation can be in the positive way, which I believe. मान लो अगर 15% का return you have expected and ideally the returns comes out to be 20% or 30%, it's good. But instead of 15%, it comes out to be 14, 13, 12 or 0. So that's a part of negative standard deviation. So that we need to understand in this case. So in this session, we talked about the 3 most important kind of ratios which are used for stock market and for the mutual funds industry as well. Sharpe ratios, Brenner's ratio, and Sortino ratio. And make note of the one thing, you should have a basic understanding of the difference between Sharpe ratio and Sortino ratio. Sharpe ratio, it takes into consideration the total standard deviation, the positive and the negative. But Sortino takes into consideration the total standard deviation, but including only the negative part or the downside part. But what happens in case of Trenner's ratio? In Trenner's ratio, you are just taking into consideration the systematic risk or non-diversifiable risk, which is represented by beta. So that one thing you need to understand.